You've heard the saying, there's no such thing as a free lunch. I find that statement to be true, especially when it comes to investing. Hi there, this is Blaine Carr with Petersen, Hastings. Today I'm going to explain risk tolerance so that you can gain a proper perspective on one of the most important concepts to investing. Risk versus reward is the main proposition you get as an investor. If you want to make more money, you need to take on more risk. If you want to take on less risk, you need to accept less in return. Risk tolerance is the degree of variability in investment returns that an investor is willing to withstand. I am going to lay out 3 very important components of risk tolerance. But first, I want to put some context around this. I strongly believe in diversification, not putting all your eggs in one basket. Therefore, any references I make to stocks and bonds assumes you are diversifying into thousands of different stocks and bonds. You can learn more about this by referencing my past episodes on investment types, bond basics, and stock basics. Let's start with the obvious. Risk appetite. You might be a natural risk taker and not have a care in the world when the stock markets plunge. Alternatively, you might panic when markets drop 5 or 10%. We all come from different places on this. The important thing is to know yourself because you are one of your biggest risks as an investor. You need to avoid both getting caught up in market highs and bailing at market lows. Risk capacity is the ability to take on risk. You might be young and decades from retirement, or you might be about ready to retire. One end of the spectrum allows you to take on more risk than the other. If the market crashes when you are 40, you might have 25 years until retirement with plenty of time to recover. You also need to consider when you need to spend the money and how long that money needs to last. If you retire today at age 65, you might need the money to last 20 to 30 years. Some of your money is needed for next week and some of it well down the road. Additionally, you might have another goal like funding a vacation, a home, or a child's education. Short and intermediate term goals should be invested with lower risk than long-term goals. Another aspect of risk capacity is how much money you have or need for your goals. Some retirees live off their Social Security, pensions, or other income. If you are fortunate to be in this position, you have the ability to take on more risk if you want to. The last component can be a little bit more challenging. Risk need. This one is goal driven. You might need to take on more risk in order to achieve your goals. Maybe you have postponed saving for retirement until you are in your 40s or 50s. You might have less appetite for risk, but if you are going to retire by age 65, you probably need to take on more risk. This all depends upon how much you can save and what your retirement spending need will be. On the flip side, you might be comfortable with taking on more risk but have a lot more money than what you need for your goals. You can certainly leave more money to beneficiaries or charities, you could spend more money on yourself, or you could lower your risk and sleep better at night. Again, you get to decide. In summary, you need to further discuss your risk tolerance before you invest. More specifically, you should focus on your appetite for risk, your capacity for risk, and your need to take on risk. Your goals will play into this, as will your age, when you need funds, and how you respond to market volatility. In general, you should take on more risk when you have a lot more time before you need the money, and vice versa. The best lever you have to increase risk is to raise your portfolio allocation to stocks or to lower your risk by shifting more towards bonds. I encourage you to check with someone who knows what they're doing before you invest. Please share this with your friends and family. And come back next time and we'll talk about taxes.